My name is Gokan. So welcome to the our panel really on family offices, the future work and essentially funding startups. Um, Today we'll try to unpack really kind of why sort of the traditional VC model might be a bit strained and is maybe going through some changes, and how some of the alternative ways of funding, whether it's DAOs or venture studios or some other ways, could offer maybe some alternative returns and alignment here. The program really is to say that we'd like to just take 5 minutes to introduce the panel here, and we'll spend about the first half just on the panel conversation. I'll try to join in a little bit here, and we'll try to open it up for the remaining 30 minutes, really to talk about some get some questions from you guys. Now, the panel will consist of Michael Greenberg, VP Investment at Osgood Properties family offices. So welcome, Michael. Thanks for joining us. We'd love to have a small introduction from you in a bit. We'll also have Daniel Ospina, so the founder of RnDAO, and really been involved in venture studios and collaborative innovation for a very long time. So appreciate Daniel for joining in, and myself. So my name is Gokan. Been kind of leading product and technology teams for quite a while. Been involved in venture studios as well, something called WeBuild Ventures, and also participating in RnDAO today. So just to kind of get to know the panel a little bit better and a little bit understanding of the world that they operate in, maybe Michael, you can give us a quick introduction to what that looks like, and then we'll go on to Daniel.
Sure, and I'm not sure how long the introduction should be, so just stop me if I'm going on too long.
Sure, sounds good.
So I actually started my career as a high school teacher. So I have a business degree, but I went and taught at my old high school for 3 years, and then I taught in Mexico for 3 years. And then I had a feeling to go back and join my family business. And the family business is called Osgood Properties. That's the name of the operating company. And it's a really simple company. So it's run by my dad, and he's basically done the same thing for 40 years. So we own and manage apartment buildings in Canada and the US. And he would just sort of buy one apartment building, and then buy another and another and a couple a year. But when I joined the family office, or excuse me, it wasn't a family office at the time. When I joined the company, there were two issues. So one, I had no interest in the operating company. Like I just no interest in property management. It's not that exciting to me, no passion. And then the second issue was that as I joined, that strategy no longer made sense because institutions were coming into the space that had been dominated by what my dad says is schmageggies, like small guys at the time like him. And so we couldn't compete. Our cost of capital was higher, our hurdle was higher. And so we had cash coming in from our operating company that we would normally redeploy in the core business, but it was just kind of sitting there. And my dad had started a family office sort of without realizing it. And so we'd engaged some banks and things. And that's really where I started. So I did 2 real estate deals, again, about 9-10 years ago. We haven't done anything since. We haven't seen anything that's worked for us. And so all our capital has been redirected to the family office. I'm not sure how much I can go into some detail as to
Look,
some of the
I think
I'll
this is
just leave it
great.
there.
So yeah, I think this is great. Daniel, go ahead.
No, I was saying, yeah, this is great. Like, I'm loving this story. Super interested to hear the rest of the journey.
So you want to do a quick intro, Daniel, just to kind of get to know you a little bit better for those that maybe don't know you well? Yeah.
Sure. Yeah. So from my side, I come primarily from an organization design background. I work in research and development and in the food industry before that. And I was seeing a lot of dysfunctions in the way mature companies were continuing to innovate. So I could see that essentially a lot of my culinary heroes, like all of these world famous chefs that I look up to, had become depressed alcoholics that no longer had any ideas. They just didn't know how to create anymore because they were very out of touch with new influences that could kind of inspire them to create the next thing. And so they were repeating the tricks they knew how to do. And as a result, these culinary empires were slowly sinking and slowly becoming irrelevant. But at the same time, they were surrounded by young, passionate people that were within their orbit, but that didn't know how to innovate. They didn't have the means, the resources, the possibilities to actually go and create a thing. So the most talented people would leave. They would go to other companies, repeat the same story of being there for a year, kind of learning a few things, but then not having room to grow, not having room to actually try what they were doing, and eventually leave and start a competing company that would become the next big thing. And it was really sad to see this human drama, because there was these young people struggling to find opportunities, the people at the top that needed the ideas, but they didn't have a way to work together. So it's kind of seeing that dysfunction, and then speaking with people who work in many other industries, that kind of got me really passionate about innovation and human collaboration. And are there better ways to make these things work, that we can create more, let's say, collaboration in the way we innovate, and be able to mobilize some of the resources that we have in some organizations to propel new ideas without people having to go into the wild and reinvent the wheel from zero. That is just so inefficient. And so I was seeing even that as I progress in my career and continue exploring this topic, that the traditional way we build startups is reproducing systematically these dysfunctions. The way we try to do innovation in corporations is not working very well. And I was like, there has to be a better answer. So the last 10 years of my life has been dedicated to searching for that answer.
Yeah, yeah. And it's again, it's, we really want to bring kind of different perspectives in. And that this is, family offices, evolving family offices from the, initial investments into something else. And then on the other side, essentially, the experiments and finding new ways of building companies, right? So quite interesting. Michael, maybe just to come back to you a little bit on what you were telling here about the evolution that you're going through here. Did your family office at any point kind of make investments into directly into startups or into funds or anything like this?
We've done it all. So it's been quite a journey. And maybe I can just sort of continue the story a little bit and
Yeah,
give you some
please.
context as to how we
Let's
got
do it.
there. So my dad, again, is like a pretty traditional guy. And so I come from like a small Jewish community, and they talk, and you just sort of go to like my dad will just go to his friend and say, who do you use as a banker? And he really didn't have any focus on the family office. And as I arrived, I had a lot of imposter syndrome. Again, I was coming as a teacher, and I was engaging with these banks and investment managers. And I don't know if you've ever met these people, but they are incredibly charismatic. And they, especially to
Sure.
someone who is sort of new to the industry, they come off, at least to me, like incredibly smart. But the longer I sort of stayed and listened to them and heard their advice, the more I realized they were just giving us cookie cutter advice, and it drove me nuts. So I was on an investment committee for like a foundation, and our investment manager, I'm not going to say the name of the bank, was the same for me as it was for the foundation, and they were giving us the same advice, even though we're a taxable entity, the foundation is not. They had
Right.
no sense that we weren't giving them all our capital. So they were getting the real estate company was so much bigger than what they were getting, but they were just so focused on diversification and like covering their ass. They just didn't want to get fired. And so my focus really at the start, and I was on my own, was like, how do we invest in a way that is appropriate for us, right? And can we
Right.
earn some liquidity premiums? Can we handle more volatility and just and invest longer term? And
Right.
so I don't know if I went about it the right way, but we did everything. So we went into private equity, venture capital. We did some direct investments into like relatively early stage startups. It was
Interesting.
yeah, it was a lot.
And what did you sort of, I mean, what did you learn from each experience, or what are sort of the takeaways from the different type of investments, right?
Maybe I guess I'll start with venture because that's what,
Sure.
that's the focus. And I'm sure Daniel will talk about the challenges of the venture model from the founder's perspective.
Yeah.
I hate this 2 and 20 model, and maybe I'm greedy, but
Mm.
I hate the fees that are charged. I hate the fact that, again, like there's this 10-year lifespan.
Right.
Also, the blind po- I
So,
started
so
to
in,
hate it.
you mean the power law essentially, right? That a lot of VCs sort of adhere to, and yeah.
Yeah, well, just this idea of like 2% management fees and then the 20% carry. Um,
Right. Right. Okay.
unless you're uh, unless you're really strong, like I don't know, unless you're like I guess a super brand name VC, then maybe you should be able to charge it. But
Got
um,
it.
I just I don't like it. Um,
So what does the venture do? What does the sort of the team do to earn that, and how are they able to deploy that better than, with your money, right?
Yeah, well,
So
and then
that's
just
the kind
our
of thing.
incentives, and we ran into this with one of the co-investments that we
Mm.
did. Like the incentives are misaligned, and we've since shifted. We have one venture partner left, like that we would do another fund with, but otherwise, like it's all direct investment for us now.
Got
And
it.
yeah,
Okay.
yeah.
Yeah. So apart from the trusting them, knowing what, how they
Mhm.
operate and how they deploy the funding, and then, obviously having some big ones that are names in the market that are maybe lower risk, but quite high management fee, possibly, right? Um, what are is there any VC model out there that works? Are there any VCs that you feel like you would invest in or try again in?
So here's the challenge, right? Like, and I'm speaking only for us, and what we've learned is
Sure.
there's 5 people on my it's so the family office has grown significantly since I started, and there's 5 people on
Yeah.
our investment committee, and I am an outlier. So we're going to invest in this one prop tech fund going forward
Mm-hmm.
because we've got a great relationship with the manager, and again, that was another thing that I really wanted to focus on is synergies between the family office and the operating company. So it's real
Mm-hmm.
estate technology that we could theoretically
Got
implement
it.
in our company, but otherwise, like we realized after 10 years that one, we don't really know the VC space, and for sure the other people on the investment committee are not suited to early stage investing. Like they just
Got it.
emotionally, it's a very different style of investing. So we're moving away from that, except for this one fund that we're still going to stay with.
Yeah, interesting.
Yeah.
Let me send this to Daniel a little bit on what's your experience been, Daniel, with looking at the VC space, looking at some of the challenges in the VC space, maybe a little bit on the other side. What are the things that you see there around working with VCs and what that looks like?
So for me, one of the things that really bothered me was that the framework pushed you to increase risk more and more and more and more. Like I just start hearing all of these stories of founders who have had exits, and I mean even like huge exits, 500 million plus, $1 billion, even sometimes bigger. And at the end, they had less money than someone that had bootstrapped their company. Just because, like, if in between the last 2 rounds, you didn't quite hit the growth curve, so you thought you were going to grow 5x and you grew instead of that 3x. And like this is still a fantastic business outcome, but for the founder, absolute financial disaster because then it's the VC that's taking all the upside. And no one really talks about this publicly because founders don't want to be, I'm a huge success, but actually I only end up walking out of this after 10 years with $3 million or $5 million, even though I build hundreds of millions of dollars of value. And they're kind of like bitter, but in secret. And in public, they're, oh, I'm a huge success because that gives them more chances to go on to the next deal. So that bothered me a lot. Like from the founder perspective, it just didn't make that much sense. But even from the VC perspective, is sometimes you just keep on compounding risk because there is a lot of businesses, and I had friends who were in this situation. They found a nice business model, but it wasn't huge. It was decent. It was a solid business, and but it wasn't going to hit the growth curve of the VC. And so they were like, oh, we now have to kill our core business. We have to pivot away from this and go find a different thing. I mean, it's a little bit like the story of Twitter. It was a great platform. Everyone loved it. It had huge network effects, like really, really sustainable. But to hit their sort of return on investments, come Elon Musk and starts gutting it. The community of users is super annoyed, etc. Anyway, eventually, like Elon Musk being Elon Musk, he finds a great way to leverage the assets and goes and does something with the data. So it's not a complete failure of a story, but there is so many bodies out there, like it's so many startups that had a nice business but not exponential growth business, and then end up with no business at all, and everyone lost all the money because you needed to keep on finding that compound growth opportunity. Like recently, there was, for example, a bounty platform, and it had 10,000 monthly active users, was working, they could keep on evolving the startup, but like the moment that you have 10,000 monthly active users, like you have a thing going on, like there is something there. And they sold it recently in an acquisition. They sold basically just the assets for $50,000. And I'm 50, that
Right.
what the hell? And it's because he wasn't hitting the exponential growth curve. So the founder had to drop it, move on to the next thing. No one was taking care. Like essentially, it just ended up stranded. So
Right. So what is the challenge? I mean, so what is the alternative to when a team, wants to raise some funding to be able to make a few bets, to then maybe grow the scale the team, get to some kind of revenue early on or in one of the first phases, right? What are the alternatives there?
So I think the really important thing for me was to understand the math. That was the unlock, because I was like, oh, why are VCs the evil guys? Why are they assholes? That's a little bit the narrative that goes around founders. But then when I went kind of to try to understand it from the investor side and kind of going more into venture building, it was like, well, the thing is, so many of these startups fail that you kind of need those exponential returns to make the math work. So how can you make the math work without those exponential returns, but more with medium range outcomes like 50 million to 500 million target for what these companies can be worth after a few years? I was like, well, those are really fantastic businesses. If I own a few of those businesses, I would be super happy. But why doesn't the math really works? And it's the failure rate. But then when you look at the failure rate, I was like, well, the issue is, and even like when I did a couple of angel investments myself, and the experience was that you never have enough time to do due diligence. You think you did your due diligence. I met the founders. I even invested in a friend of mine, and we were hanging out all the time and then talking about her company. So I became kind of like this informal advisor, like a lot of angels end up doing, because we had a close relationship and we were friends and we were partying together. So like I really knew what she was doing. But ultimately, at the end, that startup ended up getting acquired, and the acquired company failed. So we end up losing everything in a really annoying way. Like before they could pay us, like the whole thing just collapsed. And it just made me realize, like, ultimately, I knew nothing about their core business. Like, I didn't really know what I was doing. I was ultimately gambling to a large degree. And VCs, even with all their expertise in the area, are really not that different. And I say this also from in the way when we pitch, for example, Techstars with our accelerator, it was so easy for us to hide some of the rough edges and emphasize the positive edges. And everyone is playing this game, and everyone knows this is the game, and it's been optimized to kind of try to reduce that, and still you're basically gambling. That's why you just need to kind of spray and pray and have a large portfolio where the majority are going to fail, but you get lucky with a couple of them. But I don't want to play a game
Right.
for being lucky. I wanted more control, more determinism, more also being able to apply what I learned from one startup to the next. Like it just felt tremendously wasteful that every startup had to learn all of these lessons all over again. And supposedly in accelerators, you have mentors, but in the practice, they're just not that committed. Like they're not really teaching you this stuff. They tell you that your pitch deck sucks, but they don't sit down with you and make it great. You then on your own have to go and try to make it better. They give you a little bit of feedback, but you spend 2 weeks trying to make a better pitch deck. Come to them, the pitch deck still sucks. Still a really bad pitch deck because you're not an expert in making pitch decks. And then the mentor is like, oh, okay, yeah, this is not great. Let me sit down with you and do it, but I can only do it in 3 weeks from now because I have a life and other things. And in the meantime,
Right.
it's been 6 weeks and your pitch deck is still bad. So you're not actually being able to deploy the expertise into the startups. And so you don't actually have this accumulation of knowledge. And as a result,
Right.
there is so much risk and so much uncertainty and so much lack of skills, because building a startup is such a complex thing. You need so many moving parts, so many skills, so many expertise to kind of come together. And there is still a lot of risk and uncertainty. It's kind of part of it. But the system is not reducing those risks fundamentally.
So there is, look, there is an area around expertise of building early stage companies. I think that's very true, right? There is also a topic that I think, Michael raised a bit earlier around, well, I want to be closer to those ventures. I want to, if it's a prop tech, it's an industry that we know and can actually help them, open doors for them, or understand what they're building, what they're trying to do in the market a lot easier, right? So maybe there's a trend there around becoming closer, like the funding and the people behind that, and the venture and the people that build it, getting a bit closer together on specific problems they want to solve for. Is that your experience, Michael? That you do want to be able to really understand what the company is trying to do, what maybe the fund wants to do? Go ahead.
Yeah, so it was really interesting to hear Dan. I mean, Daniel, I got to hear him speak at a conference he spoke at, and was just, I mean, he was reinforcing what I've heard elsewhere in terms of that founder experience, and how um, I had this romantic ideal of a founder and a startup. Like it's that story that we see, and it's Silicon Valley, super exciting and stuff. And so to hear that was um, it's kind of like a bubble being burst. From our perspective, even in prop tech, and sorry, and the other thing I wanted to mention was Daniel saying, like, even as a VC, you're kind of shooting in the dark sometimes with startups, and things are so early. And so what we've learned after even in prop tech, even in an industry we understand, it's so hard to know like what the outcome is going to be, and you have to compare that to what we did for 40 years, where we just knew like the range of outcomes was
Right.
so narrow, and we just, not to, but like we never lost money, right? And now, you know, for me to ask them to go from that to spray and pray, like we're coming back the other way. So yeah, would it be better if we um, understood things better? We just can't do it. We can't do the early stage stuff. We can do, when Daniel talks about these, I don't know I guess, I don't know, are they lifestyle businesses or those businesses that aren't going to turn into the super home runs, but are good businesses.
Right.
That's
Yeah.
stuff that we can kind of look at more now.
Got it. So because you mean that, because they have sort of revenue and they rely more on the revenue than sort of the buzz around building and burning capital, right?
Yeah,
And
not just
for
revenue.
you, yeah.
Like so, ideally profit, right? Like ideally
Right.
some actual income. And again, this is just learning who we are. And I'm jumping around a lot. I'm likely gonna go out on my own to some degree, just because my family office has shifted to like a more conservative strategy. But even
Hmm.
on my own, I also don't want to gamble. I want to know, I want to have
Right.
like a sort of a deep relationship with whoever the founder is, and it's got to be later stage for me, so that there's something tangible and concrete to base
Right.
my decision on.
So we have the founders, we have the idea, the market,
Mhm.
what they've been working on. But in terms of like partners in this space, right? What has been your experience in terms of partners that again is helpful for you and partners that are maybe necessary, not that helpful in this process?
Um, yeah, so the way I think about things is like there's risk, right? And there's, I don't know, an upside scenario and a downside scenario. And ideally, in an upside scenario, things go like your partners act really well, and things go even better. And then in a downside scenario, they kind of mitigate the downside. And so I've had extremes on
Mm,
both sides. We did a co-investment with a fund that we had a pretty close relationship with, and I don't want to get into the details, but we were in a safe,
mm,
and they manipulated the valuation of of the following round, such that it made
Got
it look
it.
like the valuation was a lot higher than it was, and so we converted it a higher um, like safe price. So we converted a 20% discount to
Got
an
it.
inflated valuation,
Makes sense.
and
Makes
it was
sense.
part of it was they were going public via SPAC. It was really messy, and I was just so honestly hurt. Like I'm a human being. I felt honestly
Yeah, yeah, yeah.
betrayed by how things went. And what was interesting is we were the only ones that caught it. We were the largest investor in this company but no one else noticed or caught it, which scared me. So that's one example of a partner just we had to sue. It was terrible. There's another example where we're invested in this manufacturing company, and they were 2 or 3 weeks away from bankruptcy. And this is a friend of mine, and he's one of those people who like saw off his arm before he loses money for a partner. And so
Mm-hmm.
he invested again. He fired the CEO. He made it work, and that company now uh, has turned it around like almost exclusively because of him and his contribution. So yeah, I mean partners are everything,
Yeah.
and you see that especially when things go poorly and how people respond.
Yeah, clearly, clearly. A lot of stories, and actually, a lot of investors actually don't want to share these stories, right? And it's not, it's something that is under the carpet, not mentioned. They want to talk about the
Yeah.
successes and even in private sometimes. So, thank you for sharing some of these
Well,
stories, and
can,
it's
can
good
I
to
just
hear kind
add,
of a
like you
yeah,
can't. So like this awful thing happened to us,
sure,
and we won't share it with our community because it's just not worth it's not worth the drama. But it means like this
sure,
person continues to be able to raise money, if that makes sense.
yeah,
So yeah.
makes sense, makes sense. I'm wondering about, now that we understand sort of the landscape a little bit, I'm wondering about some of these more alternative ways of investing or collaborating, innovating with some of these, other partners in the market, whether it's venture studios or swarms or some of these, kind of other ideas, right? Maybe Daniel, you can give a quick intro to what are the ways that you're thinking about this kind of partnership and what that looks like, how it operates and how it's different.
Yeah. So first, from kind of, let's say, a program manager, a fund manager, um, let's say the operator and the startups. What we were hinting at before, that of that relationship of getting closer and having a little bit more control, that's kind of like the trend I've been seeing with venture studios, which is kind of, we're not just going to wait to find good founders and give them money. We're actually going to build startups, and we're going to get our hands dirty. So that's kind of the operating company being able to do research, identify problems, brainstorm ideas, then go and validate some of those ideas, build products, and then sell them and scale them up. So it's kind of moving from, I call it like a move from a cottage industry where like everyone is doing small things on their own, to building factories and assembly lines that are optimized to do every step of these really, really well. And doing that at a slightly bigger scale. So instead of, let's say, a team of 3 entrepreneur, a team of 3 building a startup, you actually have 2, 3, 4 startups in the go, and an expert team that is plugging into these startups. So you have user researchers who are researching one opportunity, and then they move to the next, and then as the startups kind of go from a loose idea to a business and start to mature in that process, you start to build more capabilities within the startup. But at the beginning is the studio doing it to a large degree. And there is different frameworks there. Like there are some studios, I learned about some studio recently in biotech, and they go everything from idea to IPO, completely in-house, no bankers, nothing. This is like the most extreme version of, like, they just run a complete assembly line where they do absolutely everything from A to Z. And they are super good at it. They also have loads of financial expertise to be able to IPO themselves, etc. Then you have others that are kind of a little bit closer to a traditional accelerator. Is like Entrepreneur First is done really well in the UK. And what they do is they bring in potential founders. They put them in a cohort where they meet each other. They do matchmaking. So they essentially build the teams, and at that moment, the teams don't even have an idea. They develop the idea, and if they like the idea, then they deploy a little bit of money, and they start working with these teams. But they are there even before there is a team and before there is an idea, even though with a slightly more accelerator, more like cohort light touch. In RnDAO, where we have tended towards is that we are finding that the founders were often not very good at doing the primary research, like understanding what is the landscape of opportunities. And so if we took that on and did it in a more systematic way, while we then bring in founders to validate the opportunities, because we have identified, we get some market signal that there is something there, but we don't yet know if that's going to fly or not. So then we bring in the founder to go and do customer research to try to sell it, essentially before building too much. Let's try to sell it and let's try to generate some revenue before we invest hundreds of thousands of dollars building technology. That approach is where I get more and more conviction, because the founders develop a sense of ownership through that validation process. They start to iterate the idea and they make it their own, which is really important so they can stay around when things are tough. Because if it's not their idea, then they could just leave it and move on. But at the same time, we're being able to leverage some of the expertise of the studio. And then we're accompanying the founders there. So everything we learn from one startup, we incorporate into the next one. And when something doesn't work out, we can do a post-mortem, understand what failed, and make new mistakes. Not keep on making the same old mistakes, like happens with first-time founders. They're making mistakes that people have made through history over and over and over. But anyway, if they don't have that support network, they make them same mistakes again. So there is that. And the other thing is, I guess, related a little bit to the synergies that Michael was also talking about, is that if you go into a niche and develop expertise there, then one venture can work nicely with the other. So there is, in corporations, you have these through what's called economies of scope. So Salesforce sells you one product, and the moment that you buy one, you are hooked. And then they're going to sell you the second one, and the third one, and the fourth, and the fifth. And before you realize, you're paying them loads of money. So that same dynamic of cross-selling or being able to create a portfolio of products is something that startups are not able to do, that often forces them to exit, or a lot of startups end up in the situation of this should have been a feature, not a product, and becomes an unviable business because it's not a complete solution unto itself, even though it's a super valuable feature. So what we end up with is this slightly new concept that we're calling swarms. There is already examples of these at scale. Like there is a Fortune 500 company called Haier. They're a Chinese IoT white goods manufacturer, so fridges, air conditioners, and funky house IoT software, so your kettle knows when you arrive home and starts boiling the water or stuff like that. But they were able to create this ecosystem of startups on top of their platform that integrate with each other. So they can do things that only large corporations can dream of, but they do it with the speed of startups. And that combination has meant that they are outperforming everyone else in their sector. They've grown a lot. They were used to be this small backwater factory, like low quality factory in China. And now they're a Fortune 500 corporation that is acquired the kitchen appliance arm out of General Electric in the US. And in a few years, increased profitability by 16%. And also increased employee engagement. Like, is this one of these crazy models that actually ends up being better for everyone else because it's just more efficient? So
right,
kind of borrowing that idea of creating a swarm, or like these small pockets where still you have some autonomy and can move fast and independently within each startup to really explore opportunities, but then can create some collaboration across them, is super interesting. And here there is like a VC fund that also pioneers some methodologies around this that is called Kindred Capital. And they're now in fund 3 or 4, like fairly successful VC fund. But every founder they invest in gets some ownership in the portfolio. So that means that every founder has some ownership in every other company. Now, they're a generalist VC fund, so there is not that much surface for collaboration. But we took that idea from them. We kind of borrowed the insight. And because we're only focused on this collaboration tech space, like future of work, that's kind of B2B software, that's kind of our expertise. We're applying this idea of cross-ownership and collaboration between the startups to try to emulate a little bit like what Haier, this massive corporation, does, we can emulate that at a tiny scale with this approach from Kindred Capital. And it's already starting to work. You already see some of the founders chatting with each other about, hey, what if you integrate your product into mine, and that allows us to do this more complex thing. And that doesn't happen nowhere as much in the wild, because building trust between startups is really hard. While here we are curating the ecosystem, we work very closely with each of them. So it kind of combines with the venture studio approach, is because we're not just betting on founders from a distance. We're actually in the teams. We're shoulder to shoulder with them. So we have loads of data about who they are, what their character is like. We can advise them and say, maybe I know they're suggesting that, but maybe wait a little bit because they haven't got market validation. So that's going to be bad for you. So we can kind of like steward the ecosystem and look after the well-being of all of them, while also helping to create trust by being this curated.
So I'm just wondering, Daniel. So I'm wondering actually from Michael's perspective, these models, how easy it is to sort of understand the inner workings of it, because it is a bit different than the models that you see out there, traditional VC models, startups that we discussed earlier, right? So I'm wondering, what are the parts that kind of resonate with Michael? What are the parts that maybe is questionable, challenging? Yeah, let me hear.
Look, I don't know if it would fit for our family office again, but I just love.
Yeah.
Maybe I can back up and say just for a second that, I was a high school teacher and I felt like I was making impact every day. And as a capital allocator, there's a part of me that's like, if I'm just allocating capital to, say, Apple Compute, like, or just, I'm not necessarily, if I'm just moving money around, then nothing's really happening and I'm not really contributing. And so I get really excited in, investing in companies that are innovating, where I love, like, there's just so much I love about what Daniel just said. Like, there's actually, I love that there's innovation happening in a model that everybody understands is broken. And I love, just like so many parts of that, particularly the collaboration part. I guess one question I would have for Daniel is, can you scale that model? Like, how many founders can you maintain a relationship with in terms of knowing them intimately and sort of fostering these connections between the different founders and because it just on the surface it just sounds like just a much more effective model. And this idea of all these founders working in isolation with VCs who don't really know them, I mean, this feels clearly like a better model.
Yeah.
Right.
So that was actually kind of something that I have had to learn the hard way. Neurospicy in a particular way that is very easy for me to kind of zoom in and out of details. And we work remotely. So that makes it easier to compartmentalize, because I do less of the social pleasantries. It's more like jump into a meeting, go kind of thing. I mean, like, we still keep a nice, healthy culture, but it's very, very outcome oriented. Like, we have our social lives outside of work. So we're not trying to have our social lives in work. Like, in fact, with one of Drea, one of my co-founders, I think we never met in person until like 3 years of having worked together every week, So it's kind of a slightly peculiar culture, and I kind of created that way because it's also very naturally suited to me. So I can do these with, like, I'm kind of at capacity with about 9 startups. At 9 startups, I'm like at number 10th, I cannot take it. But I can do 9. But I realized the hard way that this is more than the majority of humans can. Even extremely talented humans, they have many skills that I don't have. They might be more experienced serial founders than I am. And I try to bring them in. And I had a failure with a friend of mine who was a little bit ADHD. And he was like, after 4 startups, it was too much context switching for him. He was like, dude, this is nuts. It doesn't make any sense. So we have had to rethink a little bit some models based on that. You can in some way grow the team, and have some people that have more context on the different startups. But also now that we have more scale, because at the beginning we had one startup, then we had two, then three, right? Like you start going bit by bit. Now we're at 9, and they're at different stages. Some are really, really babies, like super early stage. Others are generating revenue and have users, etc. So they change quite a bit. But the thing that now that we have more of them, we can organize a lot more peer-to-peer structures. And this is a way that I know other people have created more scalable models and even higher at the very large scale. What they say is they create what they call micro communities. So they have orchestrators that are facilitating, let's say, a community of startups around the kitchen appliances in their case. And another one that is more like the living room appliances. And it's not that the startups only belong to this, it's not like a department, but it's more like a community of practice, collaboration, idea sharing community that you can do for this. So in RnDAO, we now started creating what we call a developer guild, a growth guild. So the growth marketeers can all go and talk about growth topics there, and they start to help each other more. So essentially, we start to move a little bit more from us doing the communication between them to us becoming a bit more facilitators of a workshop or an event or a speed networking thing, or simply setting up a chat channel for them to communicate where these things
Right.
happen. But we have had to incubate these behaviors and these collaborations manually in a non-scalable way at first. And now we're starting to translate to the more scalable things. Now, of course, there is a bunch of challenges on figuring out how to do that so we don't lose quality. But I know of models at scale that have succeeded. So that gives me hope that it's quite possible for us to keep on growing.
Right, right. And the question is still around this, like, well, how do you communicate that to the right partners that then could be interested and understand the model, right? To then be able to kind of fund some of these startups and these communities. I think that's the question, right? I mean, what Mike alluded to earlier was that, well, we can't get deeply involved in a startup and the day to day. That's not kind of how family offices, investment kind of funds work, right? So how do we bridge this gap? How do we, ensure that we can explain and communicate about this kind of new ways of doing things? Any thoughts on this, Michael?
So we're different types of investors than we were 10 years ago.
Mm,
If you had met me 10 years ago, I think I don't know if you necessarily need to communicate it beyond a high level. I think perhaps um, you develop a relationship with the investor and they trust you and again, we're not that group, but there are investors who I think would find Daniel's model like very appealing and they'd probably want to do a little bit more. They'd probably want to understand it a little bit better. But to
mm,
me, like I get so excited by it being different. And again, the collaboration aspect. And then also um I think the part of it that I find the most interesting is this like owning part each of the founders owning part of the portfolio and actually having skin in the game for the other founders. I just I just really like the model and I don't
right.
know. I don't know how much
It's
more
is
you
it
can
more
explain.
communal? Is it more sort of communal, community-oriented sense instead of like elbowing, startup funders elbowing
Yeah,
each
and
other? I'm going to beat you in the market. Yeah.
there's got to be that word synergies again, right? There's got to be
Mm,
ways um, to do things better. And it, I'll bring it back to being a teacher. I felt like there were times when I was reinventing the wheel all the time. And I was teaching, 15 years ago, and I'm sure AI is, but there are lessons that I could have learned faster as a teacher instead of having to create my curriculum each time. Um, and I'd imagine as founders, to Daniel's point, like they're starting from zero when they don't have to. And
right.
especially like those peer-to-peer connections um, probably help more even than a mentor. That's a I don't know if that's the
Yeah, yeah. Heard. Um, I'm wondering if you have any questions from the audience participating here. Any questions to ask to Michael or Daniel? You can either write it in the chat or speak up. Please go ahead.
Yeah, I'll speak up and hopefully other people will add stuff in the chat.
Sure.
Michael, one of the things I'm really curious about, because we're talking about bringing that unique expertise into a space. What is it that you found your family knows about prop tech that or let's put it this way. My real question is, was your prop tech expertise more useful in selecting or in supporting the ventures that you have looked at?
So I may have missed. So we don't have a ton of prop tech specific expertise. We have property management expertise. Yeah, no, for sure. But it's a distinction that we learned about. So the first prop tech fund we invested in, it was honestly, it was just a relationship that my dad had, and we got it wrong. The model for these funds was, they could kind of go to a founder and say, listen, we have relationships with Osgood and a whole bunch of other LPs that will take your product and 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 deploy it. I would, yeah. Uh, I would say candidly, like we still, I'm trying to think. Sorry, I'm sort of going back and thinking of all these sort of companies we've kind of looked at and thought about employing. I will say we looked at doing some co-investments in some prop tech, and we could actually, unlike other startups, we could bring it to our ops team, and they said, for instance, no, we brought it to our partners in Atlanta. There was this company that wanted that had software that helped with like predicting delinquencies, and so we could just be more educated. We actually had a way to test the product in the field in some
Right.
instances. Yeah.
Yeah, awesome.
Thank you for the question.
Yeah. And look, so one of the things that we weren't going to bring up, and I think Florence, President, would have been great on this, but it is around IP, right? It is around, well, how does this work when you have collaborative environment where people are sharing, working together? Like, how do we think about the IP? How do we think about who owns it? How does it work? Um, any sort of thoughts on this, Daniel, about when it comes to IP?
So yeah, I was just also reading a comment in the chat from Neil, who was also talking about these IP blocks, and I think that's the bit that is really underestimated in startups. Like, founders don't perceive the value of these upfront sometimes, unless it's like purely commercial IP, like, oh, I have an AI and this is the data for my AI. Like, that is easy to understand. Or here is a customer list, a mailing list of customers. That sort of like IP or assets make a lot of sense. But I find it's more on the operational know-how that really the big unlocks happen. And the founders don't always get this upfront, but I think they do get it when they start to see the difference. Also because in a way you're saving them from making the mistake. But the ones that have failed startups before, like we had especially someone who, she was part of a startup. She was like a co-founder, tech startup. They raised a few million. They built a lot of technology. They never market tested. They didn't do enough user research. And after like 4 years of that startup, 3-4 years of that startup journey, they had zero customer traction. They had a lot of technology built, and the whole thing was a sinking ship. And it's people like that then when she comes to us, is like, no, I want to join because I know how not to do it. Now I know that the value of someone that's going to orient me towards a good process for validating and building a startup is so important. And she ended up joining and working with us because of that. So it's kind of these things that you learn in hindsight. Sometimes it's harder if you haven't gone through those experiences, but those terms of how do you operationalize user research? We have another venture, like they've been operating for 3 years, then they joined us. Actually, they already had customers, etc. They got to 40,000 or plus customers at some point, and then started dwindling down, and they didn't really understand why, or what were the barriers to adoption, why are we not growing, all of these kind of things. We're building features, but then they realized that a lot of the features they were building were requests by customers, but were not really an analysis of what were the customers' pain points and the jobs they were trying to do. So it's kind of like nuances and subtleties that you learn when you have done the same thing many times over years and learn the ways to do it wrong until you find the ways that really work. And that sort of knowledge is priceless when you are working against time. And in startups is really a fight against time. Like you have a number of months of burn rate, and if you don't get traction before that, you're dead. So being able to save weeks, months of not doing the wrong thing makes all the difference. And of course, that's investor money that you're burning. So then either you can raise less money or use the money to grow or use the money more efficiently. So that's a lot where the efficiencies in the system come from. But is hard to quantify. You can look at the profiles of the people involved, but it's not like an accelerator where it's like, oh, look at the profile of this mentor. It's really the assets, the IP assets and the processes that you start to build. And when you bring multiple experts together and it's the experts that debate, like it's been fantastic as we have accumulated more talent in the RnDAO team of senior people to see the ways they think different. And those are the most valuable conversations. Is having 2 free senior people discussing how should we do this together with the founder. And then we end up together agreeing on a process that was better than what we ever had before. And that becomes a super valuable IP that then we can write about and make some documents and make dashboards and prototype workflows and things like that. And then we can take that from one startup to the other and just roll them across the portfolio, increasing efficiency across, which is a little bit like the change management processes that a corporation does, but we're able to do it at the micro scale, I think, fairly well. I mean, we have a lot to learn there still, but I think that's where that is that type of IP, the know-how, the processes, the workflows, that for me is the most valuable these days.
So clear. And I think you gave a good example of what are the things that we're building that is of value, and what are things that can be, valuable to essentially invest in, not just only the traction, but also the IP being built in this relationship. And obviously, the awareness of IP of these, when it comes to startups, is something of a struggle, right? Like there's a lot of education needed, understanding like what does it like, how is it important to do this. So thank you for getting into that. I'm just wondering from Michael's perspective, again, just trying to represent the family office and investor in this picture, right? What is the sort of potential risks involved in looking at sort of a venture builder or a collaborative network like that, where the IP or the collaboration kind of is a lot of exchange information, right? People maybe getting involved in a project, getting out of a different project. So how do you think about potential risk factors of IP when it comes to that? Do you have any thoughts on this?
I'm not sure I do. I just
Yeah,
think we're not in that world necessarily at this point.
got
So
it.
I don't know if I could comment intelligently
Got
on
it. Got it.
yeah.
Makes sense. Makes sense. Look, so look great. So I think we had a pretty good conversation, just initially, just laying out the land of how Michael, you see this world, the experience you had with the experiments that you've done in the past, and sometimes it's been a struggle, a challenge to make them work. Other times, it's something that you're kind of looking forward to doing more of in some cases, right? Which is good to hear. And we also heard from Daniel around, well, how do we think about these new ways of collaboration? How do we think about new ways of not having to raise a lot of capital, burn it very fast, but actually do things where startups and companies are co-incentivized to work together and to build something that is meaningful and revenue generating, and dare I say it, profitable early on, right? Um, so thank you for Michael Greenberg for joining us, VP Investment, Osgood Properties, Family Offices. Really appreciate it. And thank you for Daniel as well to join us here, the founder of RnDAO. So it's been an interesting sessions, and I hope everybody else would enjoy the session as well.